Tracy Maitland, there's a lot of worry about what's going to happen to closed-end funds when rates finally do rise. What's your view?
You know, that's true. I think people really have to focus on which funds win and which funds lose in a rising interest rate environment. If you do the math, if rates back up, the 10-year backs up from 2% to 4%, you're going to lose 15 points. If rates back up to 6%, I think we're both old enough to remember when rates were 6%, you lose almost 30 points. So investors rightly are worried about rising interest rate environment and what happens to closed-end funds, because you could potentially have a double whammy. If you invest in investment-grade corporates and the leverage, those are two reasons why the funds would back up. But you have to look at convertibles and high yield. Convertibles in particular, we looked at how convertibles perform in the last 20 years. And in three significant instances when rates backed up, for instance in 1998 when the 10-year Treasury backed up 5.5%, convertibles were up almost 60%. And so we looked at several instances why that happens. And the reason is if rates back up, that means that the Fed believes we're in a stable to improving economy. And if we're in a stable to improving economy, that would imply higher corporate profits and therefore higher stock prices and stable to improving credit spreads. Well, convertibles benefit from stable to improving credit spreads. They benefit from rising stock prices. So it's really a winning combination for convertible funds.
Well, how closely correlated are your funds to the stock markets? You have a few convertible funds, and they've really popped in October as the S&P has come back. It's been a pretty hard year in total, but you have seen it coming back. Talk about the correlation between your convertible funds and stocks.
Well, you know, you're right. We saw a nice bounce back in the last 4 weeks or so, and I believe that the correlation should be around 70% or so of the S&P 500. The idea is to capture majority of the upside of the underlying equity market while only suffering a portion of the risk. And I think that that's what happened in the last 4 weeks or so.
All right, and what kind of investor should choose a convertible closed-end fund? They're not for everybody.
Well, you know, I disagree. I think they make a lot of sense for lots of different people. If you think about what a convertible is, and convertibles are an overlooked asset class. Many people aren't familiar with them. They don't understand how they work. But the idea is if you buy a convertible bond and it matures in 5 years, you get to collect your nice yield, and if stock goes up, you participate, and if stock goes down, you've got your yield and a lot of your principal back. So to me, conservative investors should consider convertibles, but some people consider a conservative equity strategy, and some people consider an enhanced fixed income strategy. So it really depends on what you're trying to accomplish and which portion of your portfolio.
And we've seen a lot of discounts widen in closed-end fund land over the past few weeks, and I guess we're going to see more because we're hitting tax loss selling for closed-end funds. So when's the best time to jump in and buy?
Well, I think, quite frankly, over the next few months, it makes a lot of sense. As people are going through the tax selling season, that presents a real opportunity. And I think you'll start to see some bounce back in January as people recognize the value. Closed-end funds are trading at the widest discounts we've seen since the financial crisis in 2008. It's really has not happened since then, and that really represents an opportunity. The idea that you can invest in an asset class that's going to pay you 7, 8, 9%, and you're able to buy it at roughly a 15% discount to net asset value, that's a very interesting way to be in the marketplace.
All right, well, thanks a lot, Tracy.
Thank you.
Thank you for watching The Street.